Right, welcome to week 7, where we'll look at customer segmentation, gap analysis, and cross-selling. We'll be utilizing software where we can dig deeper, construct detailed reports on these areas, and give business owners a much better understanding of those possible additional areas of income. Just want to summarize the 12-week program again and where we're at the moment. So in weeks 1 and 2, we looked at the key business growth drivers and focusing on making small incremental gains. Throughout weeks to 9, we're going to go into much more detail to give you practical, real-world, low and no-cost things to do to improve your business growth drivers by covering the following. They are quick win cash, which is the opportunities within your overheads, improving cash flow, the fastest way to improve your bank balance and your stress levels. Then we explored strategies to improve gross margins. We looked to plug the leaky bucket by improving customer retention. And now we've arrived here, working to upsell, cross-sell to better serve our customers' needs and sell more to existing customers. We'll continue that theme in week 8 by looking at strategies to increase the number of transactions and the transaction value. We'll then explore new customer acquisition, and you'll be stunned to discover just how much growth potential exists without the need to acquire new customers. Once we know how to grow the business, we need to know exactly by how much and by when. We need to grow that number to give us the lifestyle we desire. Armed with a target in terms of exit valuation and timescale, we need to know what goes into preparing for exit, and it's a lot more than people appreciate. Finally, once we have the core structure in place, we need a detailed plan, a detailed 3-way forecast covering profit and loss, cash flow, and the balance sheet in order to track and record your progress as you go forward. Whatever your goals, you need to be clear on what you're trying to achieve and by when, because a goal without a timescale is simply a wish. We need to be mindful that survival is not success and the odds are stacked against us. For those who do not have a very robust plan, the chances of success are all but zero. If your business is destined to be part of your estate and your funding plans for the future retirement, gambling on that 1 in 2,222 is not smart. Achieving your personal and business goals requires planning and process. We also highlighted the fact that we must focus on the lead indicators, so the drivers of success, because if we only focus on the lag indicators, which are sales, profit, cash in the bank, effective management control is impossible. You can only control the lead indicators that drive success. And to do that, you need to know what they are, measure them, take action to move and improve the key drivers, set targets and monitor progress over time. Remember, as of 2002, the British cycling team had only won 1 gold medal in their 67-year history. In 2008, at the Beijing Olympics, the British team won 7 out of 10 gold medals and repeated that success in London 4 years later. The team then went on to win 3 out of 4 of the recent Tour de France events. How did they achieve that success? By breaking down everything that goes into cycling and finding ways to make small 1% marginal gains to achieve an overall increase in performance. What worked for the British cycling team will work for you. These webinars are to educate you on small, easy, but highly effective ways to increase your business performance. By finding and implementing ways to make small 1% marginal gains, success will look after itself. So in business, whilst your business will have more, these 7 business growth drivers are by and large universal. Margins, overheads, new customer acquisition, customer retention, transaction value, purchase frequency, and the odd one out on the screen because it's not a business growth driver is cash flow. It is critical because if you run out of cash, there is no business. We've already introduced Alex KPI software and Alex's planned dividend payment. With an 80k profit up 33% on last year, Alex and the family are looking forward to paying themselves a 40k dividend this year. They're excited at the prospect of a holiday in the sun or moving to a larger house or a whole new wardrobe of clothes to wear. However, there is a problem and it's down to cash flow. Despite the increase in profit, the bank is overdrawn by £53,000. Alex has to explain to the family there'll be no holiday this year, the house move is put on hold, and existing clothes will have to last longer. Never mind, because next year will be better, but will it? We've looked at these 3 scenarios. So number 1, work to increase sales. We looked at the impact of 50% more sales, 50% more stress, workload, and everything that goes with it. And we saw that rather than reducing the overdraft, things just got worse. We then looked at the impact of focusing on credit control at the same time to improve debtor days. As you can see, this has a massive impact on the overdraft, moving from 53k of debt to a positive balance of nearly 54k. That's a positive movement of £107,000. Finally, we looked at one more scenario, the easiest of the lot. We looked at what would happen if Alex had simply focused on debtors by outsourcing everything to his accountant. What would happen to Alex's bank balance? We moved into a credit and a positive movement of £87,000. As you can see, busting a gut to increase sales by 50% versus reducing debtor days, the difference in the final bank balance could be as little as £20,000. Getting someone else to take care of the credit control and bookkeeping is easy, and it will almost certainly pay for itself. It will leave you with more time and less stress, so you can focus on what matters, which is growing your business, whilst they manage your cash flow for you. Forgive me for labouring the point, but getting us to take care of credit control and bookkeeping is easy, and it will almost certainly pay for itself, leaving you with more time and less stress, so you can focus on what matters, growing your business, and maintaining a sensible work-life balance whilst we look after your finance. So again, whilst your business might have more, the 7 business growth drivers that apply in some way, shape or form to every business are on the screen. We saw in week 2 how tiny improvements in some or all of the growth drivers compounds to deliver fantastic results. Once you have your 5-year goals and you've mapped your future at a high level, it makes sense to break down your targets. So where I want to be in 5 years can then be articulated as where do I want to be this time next year. Then this year can be broken down into quarters and months, or quarters and weeks, as part of a regular 9-day planning cycle. Remember to focus on breaking down the work into manageable chunks to make your life easier. So back to today. So we've completed 6 of the 12 sessions. Having looked at cash flow, margin rate, and customer attrition, let's continue to focus on our existing customers and the scope to sell more before thinking about new customer acquisition. So last week we asked you to do a little bit of homework to get the grey matter moving in the right direction. We'll be setting the same homework for next week as well, because this week and the next will be covered and running parallel to one another. So how do you categorize your numbers? Because not all customers are the same. However you do it, you almost certainly need a way to assess and measure your customers, to identify and understand their behavior better, and more to the point, what you could potentially do to increase or influence their behavior in the right direction. In this case, to solve more of the problems and issues, or to help them realize more of their dreams by purchasing from you more often and more frequently. Do you know the number of transactions per customer or segment? Finally, do you know the average transaction values per customer or segment this year, last year, and do you have targets for the future? If not, this is all something we can help you with. Please do contact us after. So today we're going to start looking briefly at the 2 growth drivers in one. So these are transaction value and purchase frequency. We'll be running through these in more detail next week, but for now we'll get started with those and customer segmentation, gap analysis, etc. If you've been following us each week, you should be getting used to reviewing Alex and KPI's key numbers. So just to be clear, let's flip those going in the wrong direction red, those in the right direction green. As we can see, there's a lot of red. And as I mentioned, today we're going to start our focus on these 2 areas that will pop up in a second. So putting all that information into a table, we've already looked at cash flow, so your stock, creditors, debtors. We've also looked at overheads, gross margin, and customer retention. So now let's look at transactions and their value. Do you know how many times you transacted with your customers last year? Do you know what your average transaction value was last year? These are 2 extremely important metrics, because only by knowing what they are, setting targets for improvement, and regularly measuring progress against plan, can you be sure you're moving in the right direction. So looking at Alex's figures in KPI software last year versus this year, we can see that the movement, good and bad, So the key question is, if we're going to look at to influence these business drivers to make an improvement, what are they going to be next year? Now, as we know before, without change, we can assume that there's going to be another 219 transactions, but also a further 12.6 reduction in value per transaction. Let's look at part of Alex's management pack. You should now be able to identify the lead indicators and compare them with the lag indicators. So sales is clearly a lag indicator or an output, whereas the number of transactions and the average value per transaction are lead indicators. So in order to improve sales, you should not be looking at the output. You need to monitor and seek control the input drivers. Let's have a look at the sales impact. So we know that sales are more or less static. So at first pass, you could conclude that this year and last year were more or less identical. But as you can see, by looking at the inputs, rather than the outputs, we can see that this year and last year were very different. But what about the impact on sales? Knowing the average value per transaction, we can calculate the total volume of additional sales Alex has enjoyed as a result of increasing the number of transactions. It should have delivered a £50,300 increase in sales, or a 5% increase in total revenue. But the 12% reduction in the average transaction value has written off all the gains, costing Alex and KPI software £52,100. The difference between the two is the 2K reduction. So now we know where Alex needs to focus attention, what is happening in your business, and what would have happened if Alex had been focusing on increasing the average transaction value every month. Chances are the £12 reduction could have been reversed to a £12 increase, and sales would have jumped forward by 10%. So let's look at what we could do to make that happen. Let's go back and look at customer segmentation. So here we can see another view of Alex's management information. Sales are recorded by customer and by sales nominal or product, service, or category. Now we can dig a little bit deeper to identify where there may be opportunities to sell more to existing customers. Let's dig a little bit deeper. We can see in this view the top 25 customers, which is typically those that account for the vast majority of your sales. Clearly, if you're running a much larger business with much more customers, you might need a more granular view. But for most of us, Pareto's 80-20 rule applies, which is 80% of sales are generated from 20% of customers. And in just about every case, of the 20% of customers who generate 80% of the sales or profit, 20% of them account for 80% of the 20%, and so it continues. So let's look in more detail at the top left part of this report. We can see the top customers ranked by total sales volume, and for each we can see exactly how much of each product or service they've purchased in the last 12 months. Let's say that sales 4 might be software development, sales 8 might be maintenance contracts, sales 5 could be hosting services, etc., etc. It will be different for every business, but you get the picture. The key question, therefore, is, are there any obvious opportunities to sell more to existing customers? Let's start with the highlighted column. We can see here there are some immediate questions to ask. Why does this customer purchase £72,000 of software but only £12,700 of maintenance? Whereas this customer who purchases 26k of software purchases 14k of maintenance. Why is there a difference? Well, looking at this customer who also purchases 26k of software, purchased 6.9k of maintenance. And what about this one? They don't purchase any maintenance at all. And what about hosting? We can see that our 2 largest customers purchasing next to nothing, whilst other smaller customers purchase a lot of, relatively speaking, and a number of clients don't purchase anything yet. Clearly, you know your business better than anyone, but invariably, when we go through this exercise with a client, there are always opportunities just waiting to be picked up. But knowing who to call and which questions to ask makes the likelihood of success much greater. Let's use another report and dig deeper. We've total purchase volume, broken down into product or service. But what else can we establish? Ignore the new versus existing and the movement year on year for now. What about the numbers of transactions? We cannot really complete the picture until we look at the average transaction value. So looking at the number of transactions and the average spend, we can see some massive differences. Why? Why do some customers purchase in greater volume? What differentiates one customer and their purchase volume from another? What can we learn, and what might we be able to do to persuade those with potential to purchase more frequently? Once you know exactly where the opportunity lies, it is frequently just a question of having the right conversation to help the customer understand what you can do for them and leading to an increased purchase volume. And what about average spend? There are some huge variations in the average transaction value or the average spend. Again, what can we learn from this? What differentiates one customer from another? Clearly, you would look at this information with a breakdown as to which products and services they currently purchase. And as a result of the process, you will inevitably have a list of customers to speak to and a note of exactly what you want to talk about. If your business does not do business via one-to-one discussions with clients, the principle still stands. This informs your communication strategy and objectives in terms of segmenting your customers and sending targeted messages to specific groups to increase transactions and or value transactions. What about customers with needs you're not currently fulfilling? So last week we heard from Daniel of Inquire 3, where he discussed the causes of customer attrition and strategies to improve retention. When asked, customers frequently identify problems or issues related to services they receive. This frequently translates to products or services that you could supply to address unsatisfied needs your customers have that you're not currently able to address. As soon as you know your customers have needs that you can provide for, this provides you immediate opportunities to increase transaction numbers and your overall purchase volumes. Remember, revenue is a function of the number of transactions multiplied by the average transaction value. So it makes sense to keep careful track on what is happening over time. We can see here the movement in the number of transactions in the most recent month. We can compare this to the previous month and the same month last year. What might that tell you? Then we can repeat that for the most recent quarter and for the most recent 6 months, compared to the prior 6 months and the same period for 12 months ago. Which direction are your key business drivers moving in, and what could you do to move them further in the right direction? So having looked at the transaction numbers, you can do the same for the transaction value. And finally, the sum of the two, total revenue movement in the month and the quarter and the 6-month periods. So where to focus? At the same time as increasing transaction number and value, what about customers in decline? Anything you can do to slow the rate of change, or better still, change the direction of travel, will help improve your results. Only by analysing the information can you understand and identify opportunities. Do you know which of your customers are in decline? And more to the point, do you know what is causing that decline? This builds on the discussion around improving client retention we had last week. All of the customers with a negative variance, so those in brackets, are showing decline in sales year on year. Why is that? We can see 4 of them are in decline here. By segmenting and profiling, patterns and profiles will emerge and opportunities will come to light. Your customer base is made up of new and existing customers. For each segment, it makes sense to know what is happening. Are your new customers this year better or worse than the new customers you acquired last year? You can see here that the new customers this year, whilst fewer in number, 79 down from 95, were better quality with an average spend of £2,800, up from £2,000 last year. Was this a result of Alex better understanding and targeting a better profile of customer, one that typically purchases in greater volume or higher value? As you'll appreciate, if we don't measure, it can be very hard to manage effectively. Maybe more pertinent for Alex and KPI software was by existing customers. We can see that whilst the overall number of existing customers did not change much, the average spend reduced from 8.7k to 8.1k. Clearly, strategies to reverse that negative trend will pay dividends. Finally, lost customers. Before chasing the new customer acquisition, can you reactivate lapsed customers? What could you do to persuade them to return? Chances are the answer to that question is also part of a strategy to increase retention, because it's far easier to sell to an existing customer than it is to sell to a new one. Without a plan, all the analysis is potentially wasted. You need to understand where you are now, where you're heading, and what you can do to address the situation. So these are the customers you're going to sell to and the product or services you're going to sell to them. So remember Pareto's rule, 20% of customers will account for 80% of revenue and inevitably 80% of your profit. So your communications plan needs to start with the 20% of customers who are most likely to deliver 80% of the results. There's just one thing left in the gap analysis and cross-selling process. And that is to communicate. Identify the customers who need to be targeted, as you saw in the image earlier, and use whatever communications medium is most appropriate to your business to inform and educate them as to the problems or issues they have and how your products or services address those issues. Remember, not all customers are equal. Let's use a cruise line industry as an example. They spend a fortune on marketing their cruises to the entire database of customers, past and present. It was the FD who did the analysis on customer segmentation, and he or she suggested they change their marketing strategy after they did their customer segmentation exercise. They looked at spend by age group, and this is what they found. The bulk of revenue generation for cruise lines comes from those of customers who are in their age range of 50 to 70. There's a good level of expenditure for the 40s, 50s, and a marked drop off after 70. So those in the 50 to 70 age group typically have more wealth. The kids have moved out, even more wealth and time for some self-indulgence. So they have time, money, health to invest in leisure activities. So rather than marketing to everyone, the strategy was rather obvious. Those who spend most cruise most, but they also started by sampling cruising when they were younger. So by the time they're in their 50s, they've already discovered they like cruising, and so they're the best repeat purchase and the highest spent customers. So who do you target? Those in the 30 to 50 age group to get them hooked and hence maximize your wallet share when they have time and the money to invest. We probably wouldn't go for those in the 80s to 90s. Their days of cruising are coming to an end. And don't forget customer loyalty and the link to customer satisfaction. You really cannot afford to have customers anything less than delighted with the service they receive. So 96% of those who score 5 out of 5 intend to remain with you, and 92% are likely to recommend your services to others. As Dan explained last week, as you do your gap analysis and establish what else you can get out of your existing customer base, the harder you work and the more success you have, the smaller the gap left to be filled through new customer acquisition. To recap the image that Dan ran through last week, this is what it looks like in numbers, admittedly with a graph to highlight the opportunity. So we have to factor in some attrition and plan for churn. So these are the customers we expect to lose. Unless we're unlucky, we also have to factor in some additional casualties caused by COVID. So maybe our actual base is not 70, it's now 55. How are we going to plug the 45% sales gap? Well, one strategy is to do everything we've spoken about today. It will take time and we cannot expect to hold on to everyone. So let's assume we can achieve a 10% improvement through improved retention. So we've reduced the gap to 35. But what next? We can sell more to existing customers, both for the products or services we currently provide, or by finding ways to provide other services or our customers need, but ones that they don't purchase from us yet, so we can upsell and cross-sell. Let's assume we can achieve a further 8% through that upselling and cross-selling. The gap is further reduced to 27%. You get the picture of what's next. Then by communicating more effectively and working on strategies to increase the size of the average purchase, we can improve the transaction frequency and value to find another 5%. The gap's now down to 22%. Let's assume our focus on getting feedback from customers, following up and working on engagements to strengthen the relationship gets us another 10% through referrals. Our gap has reduced from 45% when we started to just 12% that needs to be made up by selling to strangers or new customer acquisition. So what is your plan and where do you plan to focus? So the checklist to take away is a simple process from start to finish. So from gap analysis to the plan of action. So firstly, we need to know our numbers. So understand each area of your business so you can make better decisions. Understand attrition. So what's the impact of lost customers? Set targets for improved customer retention. How can we avoid losing customers? Selling more to existing customers. So easy sale points, those already using the services. Plugging the gaps, removing those zero balances we saw earlier and providing services to all. Fulfilling unmet requirements, so listening to customers and identifying the needs of the customer. Understand the gap that remains. Then we look to build your forecast. And finally, as we said earlier, communicate. All of this must be set in place before we focus on new customer acquisition. So the big question is, do you know your numbers and what your targets are for next year? Looking back at Alex's business, we will look at the financial impact of improving the transaction number and value next week. In the meantime, we've now covered cash flow, margins, quick win, cash, overhead and retention. We've now discussed gap analysis and cross-selling, which is the first half of the process of working towards transaction value and purchase frequency, which we'll work on in more detail to give you practical ideas and strategies that you can deploy in your business, and that'll be next week. In the meantime, are there any other questions or is there anything anyone would like to run through again there? Mel, you've unmuted
really
yourself.
Helpful. I'd just say that's really helpful. I mean, that's kind of like given me a process of where to start and what to aim for. For me, it's about breaking down those numbers. So that's, that's a big chunk of work.
Yeah, well, like you said, like we spoke about this week, though, you're looking to franchise. So for you, there's all those extra opportunities that you can go into, and then, you're going to start. At the same time, the bigger you get, obviously, there's going to be more opportunity. So there will be more zeros that start showing up, but obviously that gives you the chance to plan for it.
Yeah.
But again, as I said, it's always about having the right figures in place. So, if your bookkeeping and things aren't correct and somebody decides to just stick everything in one sale column, you're never really going to know what's happening. So as long as you're breaking down in Xero, QuickBooks, whether you're using sort of the sale types, the sale options you sell, then we can start sort of saying to you, look, there's an area that you can sell to this new customer or the current customer and grow it easily.
Yeah.
Obviously, there's certain businesses that have less different sales options, but there's always room for opportunity for everyone. But like I said, the software pulls in information, so unless you've got it, you're not really going to see that visual. So that is hopefully something people are going to want to utilize in the future.
Yeah. Thank you.
It's all right. But does it all make sense today? I mean, I think it was just we were running through bits and pieces. I mean, we can always have a look at your data. Mm-hmm. Like I said, we've had our meeting and we can always see if Xero can pull in something for you that would help you out.
Yeah, that would be good, actually. Or maybe I need to just start kind of not, I use the word tagging, but like putting it in different areas so that it's more easily.
If you don't break down your sales in your accounts or in the Xero software, you're not going to find out who's bought more of one product or not. Obviously, I know you could technically have you sell different size paellas and different types and things like that. And, if you just put all your paellas into one sale category, you won't know whether somebody's buying the larger options or they're all buying the smaller options, or whether you can sell both at the same time to the same person.
Exactly. I think it may be that it's set up. It may be that it is set up okay for me to be able to do this, and it's just not knowing how to pull it off. Or it could be that I could set it up better in order to be able to understand the information better. I
think Steve was going to say something. Sorry, Steve.
I say, presumably, David, what you're suggesting here is that we think about what we want out, And in order to know what we want out, we've got to think about what we need to put into the accounting system. So it's a question of setting up the nominals and potential subnominals.
Yeah, exactly.
You've got product categories and then potential subcategories of a different product. So you've got granular understanding of exactly what you've sold over time and who's buying what and who's not buying what.
Yeah. And as you know, Steve, so unless you put the right data in, you're never going to get the right data out, are you? So, and if we're going to look at building your future, then we can't put a plan in place with poor data, basically. And I think that's kind of, you're only ever going to get an investor in the future with the right information and knowing your numbers anyway.
So presumably today you might just do paella, but tomorrow you might do paella and tapas. So it's a question of thinking also, outside the box of, I guess, what might be there in the future. So I hope that's the right sort of association, Mel.
Yeah, no,
knowledge.
It is. Thank you.
You want to take over, don't you, Mel?
Yeah.
And obviously, I know, Linda, you're in here, but obviously, Linda, your business, I suppose, there's the training side that you can provide to clients, and obviously not all of them are utilising that. So you could start, that's another area that you could bring in revenue.
Yeah, absolutely. And also my resources idea. I was talking to a production company this week to put those and add another page to the website so that we're actually adding those training services. So, yeah, I mean, that's something. It's really also just getting my staff back up after COVID. I think that's taken up quite a bit of time, but it's also an opportunity I'm looking at now because I can train the new staff to expect to deal with the training courses and the resources. So that's also, if I get 10% off of each life coach when they run a course, that's another stream of revenue as well. Yeah,
I was just going to say, obviously, well, it's not obviously, not everyone knows, but Linda's she's an agent for actors. Obviously, it could be something for you that basically, every actor also gets a training course from you and pays for that.
It's something that I actually thought of because the new assistant, she's a graduate of the Italia Conti Dance Academy, which is much more kind of show busy than the normal drama schools. And what those kids don't have is the business and the acting side of things, which a lot more producers are now asking for. So anyway, she's going off to her graduation on Monday, armed with APM Associates business cards. So if I can grab another 20 dancers, there is an opportunity. It's just a case of me having enough room in my brain to be able to get all this new stuff started, sustain with my current clients. I've been really working on client retention because I've decided that a few 5 minutes in the day to talk to the actors is probably so valuable if they then go off and tell 5 of their friends.
Yeah, and that's also a very easy way to sell another service as well, because you've already got them engaged.
Exactly.
Exactly. So, the thoughts, Linda, that might be useful, might not. I think when you say talking about just adding a page to the website.
I beg your pardon, I missed that bit. Sorry.
I've got a couple of ideas or thoughts that came out of what you just said. So something we've discovered quite recently, and this is prompted by you saying adding another page to your website, is that there's software for putting together a learning management system and knowledge base. It's really, really, really inexpensive. So if you've got a training program, which presumably you take the training program and you can put a workbook together, so almost the DIY or the takeaway that people would take away from the training program. You could put that into a learning management system online, and then because you've got zero cost of delivery and you've got infinite capacity, you could have that as, if you like, the top of your sales funnel to actually introduce that and promote it to as many potential future clients as you wish, because you've got no incremental cost for each additional person doing it after a small setup overhead.
That sounds like a plan, because in fact it's similar to something I thought of at the beginning of the lockdown, but I actually got so involved in client retention and promoting the business, it became, it wasn't necessary. But now moving forward, that sounds absolutely fantastic. I need this next couple of weeks to get the new girl in the office up and running. But perhaps we could have a chat about that as we go into the middle of November.
Yep.
That sounds like a plan. Can you chase me, Dave, and just because my brain is exploding at the moment? That would be fantastic, because then I can set aside half a day a week to get that started.
We can chat after. Yeah.
Yeah. Because I enjoy that bit as well, because they don't answer back quite so much when they're getting something. So, right. Thank you very much for that.
That's a pleasure.
Always lovely to chat to you, Linda.
I know. I'm really lucky.
Okay, so I just think I'll finish up this week by running through the homework again and next week. So this is where we are at the moment. So we've covered 7 out of the 12 sessions now. We should be well on our way to understanding our business and how to grow. So next week, we're going to look at transaction number and value. Has that popped up, Charlotte? So again, hopefully the detail we've discussed has given you ideas and inspiration to look at existing customers in a new light. So as we're going to continue looking at increasing transaction value and frequency next week, your homework is the same. So how do you segment your customers? How many times did you transact with them? And what are the average transactions value? And again, like I said, if it's something you don't know, we can work on helping you get that information. And thanks for coming today, and thanks for your questions and comments. And if there's anything else you'd like from us, just either contact us afterwards, or just give me an email or call.